might get started. You know, we actually always like to try and start these webinars on time. We are recording them, so anyone who jumps in later can always rewatch the recording. Welcome, everyone. Thanks very much for joining us today to our International Dealing Schedule 2023. We're just putting together a quick series we're really targeted at tax agents and those that need to assist their clients on transfer pricing. So last week, if you did miss last week, it was a bit of a catch-all. We went through some of the key tricks, tips, and all of the above for tax agents in relation to transfer pricing, what you might see on your clients. Today, we're going to go in a lot more detail on the International Dealing Schedule, and then you can join us next week and we will go through country by country reporting, one of our favorite topics. I know that most tax agents probably don't agree with us, but we actually really quite enjoy it. So just a little bit about, for those that haven't worked with transfer pricing solutions before, so transfer pricing solutions, we specialize in the transfer pricing. We try to be very practical, proactive, and cost effective to provide that transfer pricing advice, which a lot of you probably realize is quite complex and often was traditionally the big end of town, the big four. Actually, most of us at Transfer Pricing Solutions all are ex-big four. But traditionally, if a business needed assistance on transfer pricing, they did need to reach out to the big four accounting firms to get that assistance. So we try to be that person that you as a tax agents can come to for your clients. And also we have companies coming to us direct as well into assisting them on that. So a bit about transfer pricing solutions. I started transfer pricing solutions from, I guess, like many of us started our business, the spare room at home, 16 years ago now, actually. I can't believe how time has flown. So we started in Australia. I started at that point providing transfer pricing services directly to clients and also to accounting firms. At that time, we did every single second tier firm in Australia's clients, a lot of suburban firms, except for two of the second tier firms. Otherwise, I provided that service to them. We then expanded into Singapore, it'd be 7-8 years ago. Time flies when you're having fun. Adriana, who was one of my founding employees in Australia, heads up our Singapore office and has been over in Singapore for that period of time. And then in the last few years, again, I think time's flying, it must be 4 years now, we set up in Malaysia. And so we've got the 3 office locations. That's been, I guess, you could say nearly supply and demand of a lot of our clients, but we do actually service our clients globally on a global scale and deal with their transfer pricing on a global scale. So transfer pricing solutions has been recognised for our technical expertise. We have had a number of wins under our belt, which has been great. The Asia International Tax Review Asia Tax Awards, that is the big one when it comes to transfer pricing. That's the one you want to win. And all 3 firms have been fortunate enough to Australia won Australian Transfer Pricing Firm of the Year a number of years ago. Singapore, when we started, did win the newcomer, and Malaysia has also won the newcomer. One thing that we are super proud of is being recognised as a tier 2 transfer pricing advisor and getting into that list as a tier 2, which is something we are trying to aspire for that tier 1, but we know that we aren't one of the big 4 as far as having that global footprint, but we're pretty proud of the global footprint we've started to expand to as well. So just a bit about myself for those that haven't met me before. My name's Shannon Smith. So I am founding director of Transfer Pricing Solutions. I lead up on the Australian side. I originally worked for one of the big accounting firms, went overseas with them in Europe and also in the US, and then came back to Australia. I spent 2 years back here at the Big Four here, and then decided I was going to go out on my own. Wasn't sure how many people would be interested in transfer pricing, but I didn't realize that there was going to be, in a sense, you could say, that opportunity or niche coming as well. I'm a chartered accountant by background, and obviously then also on the tax side as well. So transfer pricing really is looking at businesses operationally. Having started in audit, that gave me a really good base from that. I teach, if you really love transfer pricing and you want to learn more, I teach transfer pricing at Melbourne Law School as part of their master's program, where people can take that as a part of the overall master's in tax, or they actually can do it as a standalone subject, which a number of people do. I'm also on the board of tax advisory panel and have been on that panel since 2016. I'd also like to introduce today HC, Hong Tran Tan. So HC is based here in Australia. His background is actually Malaysia, but a PR here in Australia, and has been in Australia for a number of years, 10 years or so anyway, but a number of years. But what that actually did give us that opportunity, and HC was only too happy to oblige when we set up in Malaysia. HC gets the benefit of a paid trip to Malaysia, spends a few weeks over there, catches up with family and friends, comes back to Australia and spends another few weeks back in Australia. So yeah, HC very much is a director of our Malaysian operations. That has worked out really well, both locally as a business, and also I think HC, you got to see more of your friends over the last 10 years than you've ever seen for quite some time whilst moving to Australia. So yeah, so that's a bit about us as well. We also have Adriana, who heads up our Singapore office, but we're going to focus today on Australia and the international dealing schedule. So want to go through, what is it? Who needs to complete it? What does the ATO achieve? Like, why are they doing it? And then we want to go through what are our tips and tricks, the things that you won't read in the international dealing schedule explanation or the instructions, because just quietly, those instructions that the ATO gives for the international dealing schedule, if you've ever tried to read those, they're not that helpful. So anyway, we're going to try and go through a lot of those details to help you out on that side. So what is the IDS, the International Dealing Schedule? For those of you from years ago, you may have heard of the Schedule 25A. That then morphed into being the International Dealing Schedule. So the IDS is a risk assessment tool for the ATO. What the ATO is trying to gather information and give a bit of a snapshot of the company's transfer pricing position, so the ATO can decide whether they want to ask more questions or not. It's interesting, there's a number of countries around the world that have something similar. In China, for example, there is a related party schedule in China. Now, at that time, the Chinese took our Schedule 25A because we hadn't yet got to the IDS, and literally it's a mirror of our Schedule 25A. The US does have also a related party form as well, as do a few of the other countries around the world. So it's really a way in which the tax authorities are trying to gather information in relation to the transfer pricing so that they can actually make an assessment of what they want to do with it. Now, if the IDS is filed incorrectly, it can trigger a transfer pricing risk review or potential audit. So it's really important to get it right. Now, what we do when we're working with tax agents, if you've referred the client to us and we do find errors, we will tell you, we won't tell your client, and we'll tell you how to fix it next year. So you've got it. We do have a number of tax agents that will get us to prepare the first year of the International Dealing Schedule with full disclosure to their client that they're getting a transfer pricing expert to assist. And look, if the business doesn't change or the transactions don't change on an annual basis, just the quantity or dollars, then you're going to be well equipped to be able to update the schedule unless they change the IDS, which happens occasionally. But it does capture key information on the international related party transactions, and HC will go through a lot of detail on some of those. But basically, what are the transactions? How much documentation have you got in place? What countries are you dealing with? So really key things that the ATO would like to know. One thing with the tax return, just make sure when you're doing your tax return, because your tax return software does default the answer to, did you have any transactions or dealings with international related parties? And you've actually got to answer yes or no. That defaults to no. So do make sure that you have a check of that. Any client that you have that is foreign owned, please make sure that you answer these questions, because it can be kind of embarrassing for you if the software defaults to no and those questions are not answered, because we have seen that a number of times. And then the next question goes on to ask, what was the aggregate value and was it greater than 2 million? So who needs to complete the International Dealing Schedule? So basically, all companies, trusts and partnerships are required to complete it if your international related party transaction, so that's a IRPT, bit of an acronym for you, is greater than 2 million in aggregate. Also, it does touch on the foreign branch, subsidiary and trust, which we can always discuss those with you if you have a specific situation you're not sure. Now, but when it comes to the International Dealing Schedule and at the 2 million, What you need to do is really check on how you've quantified the 2 million. There's a lot of misconception in this, and that's because the 2 million, when it went from Schedule 25A to an international dealing schedule, they changed the way in which they calculate that 2 million, which some people have not realized. So the 2 million includes what are your international related party transactions. So that may be you've sold product, you've provided services. It's that figure, but it is also added to the loan balance that you actually have in place. And what has happened as a result of this is a lot of companies have been bumped into that they should have been preparing the international dealing schedule, and that button on that tax return I was talking about has not been ticked. No one has realized, and it's been rolling over. So please, any company that's dealing in or international foreign owned, please double check that and make sure so you've got that right. Now, the international dealing schedule, there's only one part that's related to transfer pricing, the part A. You'll also need to complete it if the thin capitalization provisions apply to you. You have hub arrangements, you maybe have offshore, banking unit adjustments, and the hybrid mismatch. Now, if you do not know what hybrid mismatch rules are, you might at the moment with some of the controversy and things like going on. But if you do not know what the hybrid mismatch rules are, go to our YouTube channel, and it's Friday night, better than Netflix, watch the hybrid mismatch, because I can assure you this will cover more of your clients than you actually realize. It is an issue that does need to be dealt with, and you need to make sure that you're not just leaving it to default to no on your schedule, because we've had a number of clients that have had things come up, and that's not a great outcome for you. So please, we've got a webinar on the MUL, which we did, I think, last year, and also on the hybrid mismatch. Please make sure you watch both of those. If you have clients that are foreign subsidiaries, you really need to make sure that you've watched those. So what does the ATO hope to achieve, or why did they actually develop it? If you understand the why, it'll help you with the framework. What they're trying to do is really get expanded and more specific disclosures. The Schedule 25A previously had more limited questions. The international dealing schedule, so previously it said, did you have services? Yes or no, at a high level. Now we're actually explaining the detail of those services, all the different service transactions. So it's really a great risk engine. It really helps them from a risk perspective. Who do we need to ask questions for? And what are those questions going to be focused on it? They also use the disclosures in conjunction with other information. So when you've got your tax returns, your country by country reporting. Now we've seen, I think, HC, we're seeing a number of clients come to us where the country by country reporting, and you can stay tuned till next week's session, information is now fielding down. We've had tax agents contact us and say, oh, we lodged the country by country reporting. The ATO's come to us and now told us it's all wrong based on the information that they've had shared from other countries and things like that. AUSTRAC data is now also collected. So it's all interlinked and talking. So from that, you've got a number of different government agencies using that information. And let's face it, with the budget, we heard with the federal budget earlier this year, and all governments actually, they're all broke and they need more money. So, and the big thing that I guess that we see in Australia is they tend to say these big multinational companies are not paying their fair share in taxes. Now that, for some entities, maybe that's not, maybe that is correct, maybe it isn't. But what we need to make sure is that the clients that we're working with, that we're getting the recording right from an international dealing schedule perspective, and that we've got their transfer pricing right so that we don't have a potential risk. So the ATO is using this really as a way of finding out more disclosures. You're disclosing the transaction, the country, and the level of documentation that you have in place. So what does the ATO specifically do with this type of information that they're getting? So the ATO will identify what they consider to be risky taxpayers. They may even do that based on industries and then start to look at the international dealing schedules on that. They're going to try and identify potential commercially unrealistic levels of profitability, so lower than other companies in the same industry. If they've just gone through a review with one particular industry, they will roll that out with a number of other different companies in that same industry. And they want to understand the taxpayer's level of documentation. you need to indicate on a scale of 1 to 6 how much documentation, i.e. transfer pricing documentation, analysis work have you done for those particular transactions. If you answer 1, which means, well, we haven't really done much or anything or haven't even looked at it, you have a very high chance of please explain how you came up with that number. Now, why is this important? And I talked about this a bit last week, and I'm just going to re-emphasize today. Why is this important from a tax agent perspective on what you're doing and how you're assisting your client? Back in 2013, when we got the new legislation for transfer pricing here in Australia, transfer pricing became caught under the self-assessment as we have with our normal tax returns in Australia. We lodge our tax return in Australia and we are self-assessing. When the ATO accepts a tax return, that doesn't mean they've actually accepted what's in it. They've just accepted it from a physical, yes, we received your tax return, but we reserve our right to come and check you in a period of time within the amendment periods. We reserve our right to do that. So transfer pricing became under self-assessment. So at the time that happened, we had a lot of managing directors who were the public officers did contact us to say, hey, what's this transfer pricing thing that I'm now saying is all correct when I sign the tax return? So that is where it's become under the self-assessment part of things. And why is that then important from a tax agent perspective? You need to make sure, even if the client says, I don't want to do anything more in transfer pricing, or I'm A-OK, that at least you have communicated that to the client, and that, whether you put it as a paragraph in your, annual management letter. We work with accountants. We've got a number of accountants we work with a lot that, if you need a proposal for tax, for transfer pricing documentation or a TP memo, we can give you that proposal so you can pass it on to your clients. If they choose not to do anything, you as a tax agent have done your part to make sure, because as we all know, when the ATO comes knocking, all of a sudden, clients tend to forget a lot of things that you said to them or told them or suggested they do. Oh, why didn't you tell us about this transfer pricing? Makes it really handy for you to be able to say, hang on a minute, I actually tried to get you to do something 2 years ago and you didn't want to do it. And just keep reminding them each year if that's something that they need to do. So I guess what we want to look at then is what happens when you maybe get this international dealing risk review or audit. So once they've actually identified, the data is assessed alongside with other indicators, could be profitability, tax paid. They may got something from your the country by country reporting. If you're large enough, they may be just looking at you because lots of entities in your industry, your profit is lower. Because the ATO always assumes that if your profit is lower than others in the industry, that there must be, transfer pricing mischief going on. It may not be. You may have made a bad business decision that, we had one client that took a very different angle in their industry than everyone else in their industry, and unfortunately didn't pay off for them, and they weren't making profits, and it was a problem. Now, we were able to get them through the ATO review based on commercially they made a bad management decision, but you just need to be aware of that. Now, if you are selected, so the ATO, what they'll first do is you'll get a letter saying, we've noticed on your transfer pricing, and they will request a copy of your transfer pricing documentation, or how you can support. So when you actually, whilst they didn't make transfer pricing documentation compulsory, the draft rules were going to make transfer pricing documentation compulsory at the time that you lodged your tax return. They decided at the last minute to not make it compulsory, but when you lodge your tax return, you are telling the tax office that our transfer pricing is correct. That is what self-assessment is doing. So the ATO is going to say, please provide this transfer pricing documentation to support how you believe your transfer pricing is right in your international dealing schedule, those numbers that you provided. So there'll be also a questionnaire on more detail. You may respond with that information. You may have transfer pricing documentation, and we've had clients where we've given the documentation, we've answered the questions, the ATO's gone, oh, we've got no hope here to get anything extra. Everything's all, all buttoned up, and they've moved on, gone, cleared, all, and gone along. They may actually decide we're going to take a bit more of a look here. We're not happy with some of these, or we just want to understand a particular transaction better. And so they might put you into a transfer pricing record review. So if it was under the the main, I guess you could say, tax team that was involved with the ATO. They will then bring some of the economists from the transfer pricing team and get them involved as well. We go through that process with some clients. Often with those types of clients, we might get it that we get a phone call when they've already been put into that transfer pricing record review. So if your client gets a questionnaire, please don't be afraid to say to your client, let me get a transfer pricing expert to review our responses before we send it in, because all of our transfer pricing record reviews, sometimes things could have been resolved at that initial questionnaire had there been things written in a different way, I guess you could say. So that's where we can help you on those sides of things. Sometimes we get a copy of that letter and we get, can you help us? And we need to respond to the ATO in 28 days. So we have to put our skates on and try and see what we can do in that short period of time. If we can't defend, we might actually say, hey, we need to change your international dealing schedule. We need to change this. Let's make a disclosure to the ATO as part of this. We've now identified and fixed that up. So we can definitely help you on those. Now, the ATO from the record review, if they're still not happy, they will come out on site. They may choose to either put you on a watch list, like we're not happy with 100% with what you're doing, but we need to have a bit more information, but we don't see it high risk on our side. So we're going to put you on a watch list. So we are watching. Sometimes they say that just to keep people on their toes, I think. I'm convinced of it. Other times they'll say, you know what, we're going to actually proceed further on an audit because we're not sure that we agree with your situation, or we think your functions are very different from what you're saying. An audit is time consuming and costly. It can be horrendous. Now, if you get it wrong, it can be penalties and interest. But we have had the problem with transfer pricing reviews, and actually, we've had a number of audits at time where they've been pulled in to the audit when it's already going on. So we're on the back foot, which is very, kind of frustrating. If we can be on the front foot, we can often, my goal is to avoid an audit actually at the end of the day. The problem that you do have in dealing with the ATO on that side is just probably like everyone else, except for transfer pricing solutions, we tend to have very stable staff. We look after everyone. We don't have people changing a lot. In the ATO, I'm thinking HC, that other one that went on for 18 months, I think we had 4 or 5 different ATO people. And every time we had a new ATO person come in, we were starting over again. Cost the client an absolute fortune. I think our fees alone were 10 to 15,000 a month, just at answering the ATO's questions, and then we get a new person. And at least the client knew it wasn't us trying to rack up fees. We were trying to resolve this as well. If the ATO really doesn't agree and it gets into audit, we often will then get lawyers involved because we're getting ready for court on that type of thing. And looking at whether, A, arguing it, and B, mitigating the penalties and interest. And this is why, if you have documentation completed at the time that you actually lodge your tax return, then it's considered contemporaneous documentation, and it can assist you in penalty mitigation. And what that means is, they may come to a conclusion that the ATO doesn't agree with you and they've taken a strong stance on that and they're still going to adjust, but you've done the right thing in going through the process. They just don't agree with the outcome. I guess I talked a bit about it last week, but you can get, 4 economists in a room to talk about transfer pricing, and you can get 10 different answers. Often when people ask us questions on transfer pricing, the first statement that we will say is, it depends. It depends on the facts and circumstances. I could be talking with a client and have a view on what the transaction, how we might be approaching it, and we'll get half an hour into the discussion. Then they'll just add one little extra comment, which is insignificant to them. And I'm like, hang on a minute, it's completely changed my view now on how we're going to deal with the transfer pricing. So transfer pricing is very fact specific and operational specific. But what we want to do is you want to have things in place to avoid these audits and risk reviews. That's the number one goal, because it's just so time consuming and costly for the client. I touch wood. I need to find, my desk is kind of probably not 100% wood, but I touch wood. As a firm, we have not had any transfer pricing adjustments. I've been doing transfer pricing for over 25 years. I've never had an adjustment against any of my work, and we have had cases in the US, IP migration, Japan, Europe, all around the world. So we try and build it up to, not to say, and hopefully I don't jinx myself, but if we like to build up the proper story and make sure that we have something that's supportable with, for our clients, so that we just don't have these types of situations. So now I'm going to hand you over to the real expert on international dealing schedule. HC should almost write the instructions for the ATO, I think, on the international dealing schedule, to go through some of the tips and tricks, because the international dealing schedule instructions, I'm sure many of you have tried to work out how to do the schedule, and it's just not very self-explanatory. So I'll hand it over to you. Thanks, HC.
Thank you, Shannon. I think it's a good introduction to looking at what IDS is and what it does, and what mechanism that ATO is putting IDS in place. So before we go through the questions, I would like to highlight that IDS is more or less a data collection phase. When, if you look at the IDS, what you need to do is to have a TB documentation prepared beforehand. Now, the reason why I say this is because when you're actually doing the IDS, there are sections where they will require you to input the methodology and the percentage of the documentation that you have prepared for that particular transaction. Now, without having an analysis done and without having a TB documentation in place, the person that's preparing the IDS would not be able to actually complete the IDS, or in other circumstances where you may be completing it, but then inputting a wrong methodology or wrong code into that particular transaction, which may be more of a riskier approach, because it will hit you back once ATO comes back for a review. And the general consensus is that ATO would like to ensure that your IDS and your TB documentation are consistent, right? If they have requested for your TB documentation and they look at your IDS, they do a cross-check, and when there's a discrepancy, almost 100% of the time, they will have additional questions, they'll drill down even more, then you have more issues from then on. So the rule of thumb is you need to have the TB documentation in place beforehand, and that it should IDS should reflect what you have done in the TB documentation. All right. So without further ado, let's go through the questions in the IDS and look at what are the tips and tricks that we should be aware of when we look at the questions. Now, first up would be question 1, which relates to country by country reporting, which we will cover in the next section. So how this question is actually very important, where a lot of tax agents actually miss this, where they assume that because of the Australian entities point of view, the business operation is actually very small, but they are not of the view that they may be part of a bigger group that may fall under country by country reporting obligation. So that's very important that we'll actually go through it in the next webinar. And 1B will be a administrative solution where if CBCR actually applies to you, then you can ease certain compliance burden, where if you're lodging a CBCR before at the same time with your income tax return, then you actually do not then need to complete question 3 to question 17 of this IDS, right? So then that will be a redundant if you actually prepare question 3 and question 18. So that's more or less a administrative solution. Next, we have question 2A. Now, question 2A, similarly, how it would trigger you to actually prepare IDS in the first place, or to look at IDS in the first place. You would have been triggered in the tax return itself, which is question 17 and 28, where if you tick yes, more or less we have to prepare IDS. And 2A is just to confirm again on the 2 million turnover, 2 million aggregated transaction. As Shannon has mentioned, it includes your intercompany balances as well. So please bear that in mind, that a lot of times it's the balances that actually put you up that 2 million threshold, which means you need to prepare the IDS. Then question 2B, it relates to looking at whether to exempt certain entities out of preparing the IDS. Now, 2B, it looks at whether you are a small business entity. Now, not a significant global entity, which is your country by country reporting. This leg of the question would be small business entity, the threshold is actually below 10 million turnover, aggregated turnover. And then the next question is whether your related party dealings do not exceed $5 million and 50% of your current year aggregated turnover. Now, 50%, obviously, the small business entity turnover is actually 10 million. So if 50%, if you exceeded 5 million, automatically, you don't even need to go through your 50% calculation because you are already over that 10 million anyway, if you have 5 million. And if you're below, then you have to then calculate whether 50% of your aggregate is it over 50% or not, right? So this is an avenue that if you are a small business entity and you actually is eligible for this, then you actually do not need to prepare question 3 until question 17. But then again, you still need to prepare another section. You still have to have other sections to go, section B to E. So make sure that it's only question 3 and question 18 that you're not required to prepare, but you still have to go through that whole IDS to make sure that all the questions are completed accordingly. Now, this is question 1 and 2. Next will be question 3 and 4. The objective of question 3 and 4 is for the ATO to look at what are the top 3 countries that the taxpayer is dealing with. So question 3 deals with non-specified countries. Question 4 deals with your specified countries. Now, the difference is that specified countries are, you can actually look at the appendices in the ATO website where they have listed out all the specified countries that should be under question 4. Specified countries generally will be those countries where their tax rate is significantly lower than Australia. Hence, you have to keep that in mind, especially for Hong Kong and China, where it is actually separated. Now, China is not specified, while Hong Kong is. A lot of the times where we would assume that Hong Kong will be deemed under China, but actually it's actually separated into 2 different categories. And a tip for this is that, generally speaking, you should complete the other questions first, which is question 5 to 18, where you have all the details disclosed, and question 3 and 4 is more or less a summary of all the transactions from question 5 and 18. So once you complete 5 and 18, go back to question 3 and then repopulate your top 3 countries for each question. All right. Now, next we go to question 6. Now, question 5 is more or less the disclosure of tangible properties. So that's more or less pretty straightforward. You have stock, purchases, sales. It should go under question 5. Then when we have question 6, it relates to your royalty and license type transaction. Now, the first thing you need to know is royalty versus licensing. Both have different definitions, right? You need to make sure that royalty definition will be in relation to the rights to use or rights to manufacture, versus license is actually just to use it, and you are either having more or less a license of a software, but you can't actually modify, you can't change it. So when you have this question and we have royalty and licensing, make sure that in your transfer pricing documentation, it is properly documented and properly analyzed as to whether it is actually a royalty or license, because under question 6, right, it is separated into royalty fees or license fee. So make sure that that is properly documented down. And the next one, which is a very common misconception, where a lot of the times taxpayers, clients, they purchase a so-called shrink wrap software, which in that particular case, it may be deemed as stock or inventory, which should be disclosed in question 5. Now, again, case by case basis, it depends. So really, we really need to look at the circumstances behind that particular transaction before then disclosing whether it's actually question 5 or question 6. And lastly, for this royalty and license, it's based on your tax deduction income rather than your accounting value. So bear that in mind. Next, we go to question 8. Now, question 8, one of the most important questions that you need to be aware of, which is the service arrangement question. Rule of thumb is for question 8, you have to separate transactions that are services in essence against those that are non-services related. A lot of the times where the services that are being provided should then be in service arrangement, while transactions or arrangements that does not equate to a service arrangement should not be inside this service arrangement. I'll go through some examples here, like for example, management and admin services, where it includes only routine-based services, right? Management, admin, even though the management part is a bit gray in that sense that it excludes strategic management type services, right? Management and admin is more towards admin type services. And when it relates to other than admin, but it will have employee-based, share-based employee remuneration, for example, then the share-based part should be relooked at in your TB documentation to ensure that is it a management admin services or is it a share-based employment remuneration plan that should be disclosed in another question, right? And next you have insurance services. Now, insurance services part, where in this scenario, under question 8, it involves management of insurance contracts, involves provision of insurance services, actual services, as though you are the insurance provider, right? It does not include any premium and reimbursement in relation to insurance contracts, right? So bear that in mind. Then lastly, the R&D. So R&D, where you'll be looking at whether the entity actually provides R&D services as opposed to IT-related services. Now, the definition of research and development services is actually of a highly technical service, where it should be then distinguished between highly technical versus support-based IT services. So when you do have a development of software in place, then that should be under R&D. But if you have other IT services, for example, your maintenance, your web hosting, anything in relation to more of a routine-based IT services, then that should be under software and IT services. So make sure that you distinguish these two properly, and it is properly disclosed in the IDS. Now, the reason why I say it should be properly disclosed is because, as Shannon has mentioned earlier, ATO will be looking at all these transactions, and R&D is actually one of them where it will have, I would say, higher risk category in ATO's point of view, in ATO's engine, where you have an R&D service. Most of the time, then they will start looking at what R&D services are there, what methods you have used, and what percentage of documentation that you have prepared based on that for the R&D services. So bear in mind that when you have R&D services, your TB documentation will have that proper analysis in place. All right, next, going down to 9 and 10, much less arrangement that we have, but when you have a derivative type arrangement, then please we look at what coding, what type of derivatives are there, what pricing methodology are put in place to price that particular derivatives. So now ATO emphasized a lot in financial type dealings. Hence, within the IDS, you'll be able to see a lot of different types of financial dealings. For example, derivatives, even debt factoring, which debt factoring here means that a particular entity is selling their payable to another entity at a discount, right? Hence, that debt factoring or securitization, where a particular entity is selling particular type of share-based items to another entity. So, I mean, this is quite rare, but it happens. So make sure that these arrangements, you really need to look at first the methodology. Secondly, under that factoring, the book values, what are the considerations that is put in place, and then the percentage of TP documentation that has been accounted for. So make sure that you separate debt factoring versus securitization, right? Because one is that, one is more about equity based. Next, we have question 11. Again, it's financial dealings, but it's more towards loan based. And for financial dealings, for loan based, here I want to highlight that it only includes your intercompany loan arrangement, and it does not include trade based arrangement. So please exclude trade based your receivable or payable out of this loan balances. And under question 11, you have interest bearing and interest free loans. Make sure that you actually separate those accordingly, and making sure that your interest expenses and interest revenue are properly disclosed as well, whether you have inbound loans or outbound loans. Then when you have interest free, again, this interest free can be a trigger to the ATO because now they have introduced the interest-free disclosure under their practice compliance guidelines to deal with interest-free. But once you have interest-free, ATO will have a view that you have interest-free loans. Then it will be a trigger to the engine for further review. So make sure that if you're interest-free, TP documentation should be properly documented why it is interest-free and what are the measures put in place when you have interest-free loans. Next will be your guarantees by bank, guarantees by entity, and then you have your insurance and reinsurance. So this is where you have premiums or recharges of insurance, should be in question 11 instead of question 8. And then other than that, you have other financial dealings that doesn't fall within these three categories, which also includes your gains and losses, which I'll go through a few points below. To emphasize loans, you need to have that debt equity element in it to make sure that it's of debt and not equity. And then to highlight that the average balances, which again, a lot of misconception here, where a lot of taxpayers would think that average balances equals opening balance, closing balance divided by 2. Is actually opening balance, closing balance, and your quarterly balances, 3 quarterly balances in the blue, which will have 5 balances in place divided by 5. That's the actual correct calculation of your average balances for intercompany loan. Lastly, you have your forex gains and losses in relation to your loan arrangement. This is under 11G, and these are your realized gain and losses, which should generally reflect what you have in your income tax return. Obviously, it may be part of your realized gains and losses, because this only is in relation to the loan. But the tricky part here is that it doesn't only include loan, but includes other receivable and payable, including trade. So any forex gain and losses, any realized gains and losses in relation to loan, any debt related, trade related, should be disclosed here. And bear in mind that you have different coding for each type of debt. So make sure that you actually disclose it accordingly. And for you to know where the definition of these type of debt or type of methodology, type of coding, you can go to the ATO website where they have their the appendices where you can actually look at what the coding relates to, right? And then question 12, which is your other revenue dealings. So this deals with all other transactions that are not within 5 and 11. The most commonly used in other revenue dealings are your recharges, your reimbursements, where this is where it distinguishes between your services and your reimbursement. A lot of the times where you think that it's a reimbursement of accounting related transaction, is actually not accounting services, but it's actually more to its third-party accounting provider charging entity 1, and entity 1 onward charge to entity 2 for the benefit of using the accounting services. Now, these are recharges and not services provided, because entity A is actually not providing that accounting services, so to speak. And next, another catch-all question, which is your non-revenue dealings, and it's in capital nature, where you have your disposal and acquisition of tangible or non-tangible, intangible transactions. So these should be in here. And again, we look at the coding, it will be different from your revenue dealings coding and the methodology used for the pricing purposes. Next, we have question 15 and question 16. Yeah, as I mentioned earlier, we have share-based employee remuneration, both inbound and outbound. This is particularly, it really depends on whether it should be disclosed as a share-based employee remuneration, because analysis will need to be performed to ensure whether it's more towards a admin type services or it's an actual share-based employee remuneration. So admin type services in relation to share-based payments should then not be here, but in question 8, that is the service provided. But then here it relates to more towards share-based employee remuneration. So this one, you need to have proper analysis to make sure that it should be disclosed under question 15. And then question 16 will be your cost contribution arrangement. Now, CCA relates to any arrangements where your entities are actually contribute to costs to develop a software, develop any IP. Now, this again will be a sort of a flag to ATO because of the arrangement between CCA versus services, for example, where CCA here, it is entity sharing costs. There are no markup element in it. So make sure that you have proper agreements in place to describe and properly delineate this CCA arrangement, right? It's actually a very important question to deal with. If you have CCA, make sure you have agreements, make sure your TB documentation has analyzed it, and then only then you can tick yes that you have a CCA, because it's risk flag, and ATO will 100% ask you your CCA arrangement. How do you derive into the CCA? Next question would be, right, question 17 and 18. And question 17 relates to your restructuring. And the objective of this is to relook at whether the business operations or even the shareholdings or ownership structure has changed since the previous income year. The main objective is, if there are changes, then has the taxpayers done anything to that restructuring, whether proper analysis has been done, whether they have relooked at whether there are any acquisition, disposal of ownership, or any change in business operations within the group itself. So this will then allow the ATO to see whether it is of a risky transaction or not, or whether it is by looking at your overall transaction from question 5 to question 16, for example. Next, question 18, which is your branch operations. Another key point for branch operations is that your financial statements will be a bit different, where branch operations would have financials that are included in your entities as well. You need to then disclose your branch operations side of things, right? Be it whether it's included in your financial statements, and actually separate it out as a branch standalone. And then these figures will be based on your tax deduction and income-based values. So bear that in mind when you have branch operations in place. Then after completing your question 5 to question 18, then you go back to question 3 and 4 to summarize all the transactions that you have disclosed under question 5 and 18. But the caveat is only the top 3 countries. Now, the IDS doesn't stop here. We've only just completed section 8, right, which is more towards the international TP side of things. Other sections of the IDS includes financial transactions, as Shannon has mentioned, interest in foreign entities, TINCAT rules, financial services, miscellaneous and hybrid mismatches. Then only then you're actually completing the whole IDS. So some of these tax agent would have more details on, like for example, TINCAT rules, your financial services, as well as the more important one is the hybrid mismatch. I think more question needs to be raised to your client to ensure that the supply chain does not have any mismatches in their tax rate. So, and a lot of the times that once that has been asked, then only then they realize that there may be a hybrid mismatches in place. So make sure that you deal with section G as well. And lastly, I just want to go through some key takeaways from this session today. Now, obviously, IDS will be the first point of ATO because there's no view of the TP documentation. It's not required to be lodged to the ATO. The next step will be for them to actually look at your IDS, whether you're of a risky position or not. Then only then they'll go forward to a review and then an audit. And secondly, a lot of values are based on accounting values, apart from those that I've mentioned earlier, where it's based on your tax values. And then thirdly, which is very, very important, consistency between your TP documentation and IDS. Make sure that the client has the TP documentation in place first before you deal with your IDS. Without the TP documentation, you will not have any view towards what to disclose in your IDS, and make sure that both reflect each other. And then, as I mentioned, the ATO website, the good part is you be able to see the methods, coding, numbers, percentage of documentation. That is more or less you can see it, but other than that, it may not be self-explanatory. And then lastly, revenue versus expenditure, to properly disclose revenue versus expenditure. All right, maybe we can see whether there are any questions to be asked. Shannon, you're on mute.
There was one question, but I think you actually probably, please put in the question if it didn't answer your question, but there was one question. My client says they have TP documentation prepared by head office. So how do I complete the international dealing schedule if I don't have it? But I think you actually just answered that question just then when you're going through. But if you don't have the TP documentation, I guess it's a case of requesting it and telling them that you actually need it. But also you might be digging through to make sure that what they've got, because I guess often the TP documentation from head office may not have all the details of the transactions that you may be able to access in their accounting records here. So I think you need to ask the question to get that. Yeah, exactly. I think you need to make sure that you have view of the TP documentation before even preparing the IDS in the first place. Yeah. So that was the only question that's come through so far. I think you've answered all the questions. Maybe it's too easy now. Yeah. Well, I hope we help with answering some of the questions or some of the tips and tricks that can confuse some tax agents. Yeah. All right, so maybe you can close off or wrap up the session. Yeah, so how can we help you? As we've mentioned just during the session, there's a number of different areas. Obviously, there's transfer pricing documentation. We can review the international dealing schedule. I know a lot of our accounting firm, I guess you could say partners, that we assist them with their clients' transfer pricing, get us to look at the international dealing schedule, prepare it first year. But also there's these PCG analysis as well, especially PCG 2017-4, which is on the financing. If you have debt, any debt pricing with your client, that is absolutely important. This is not TP documentation. This is the ATO, and this actually happens in the corporate tax world as well. There are a few PCGs out there. This is the ATO saying, this is how we're going to look at financing arrangements. Here is our PCG. This is basically how we're going to look at it. Now, you might want to test yourself on it and see where you come out, especially around the hybrid mismatch rules. The new one around, I guess it hasn't finalized on the intangibles, looking at centralized operations. Now, there's been a few cases that have come out recently around Singapore, procurement hubs as well. So highly recommend having a look at some of those for your clients, if that's maybe going to be a risk for them. If we have any other questions, I haven't had any other questions coming through. If you have any other questions, ask now, or I guess you can reach out to us later if you've got a specific question as well. Now, we are recording today. We record all of our webinars. As I mentioned, highly recommend you go and have a look at the hybrid mismatch. Go and have a look at last week's one if you missed it. Next week, we will be talking about country by country reporting. So that'll be next week. So you can come armed with all of your questions that you may have, because there are a few curly ones around country by country reporting. And then feel free to reach out to either myself, HC, or anyone in the team. Happy to help you on a global level from a transfer pricing perspective, but we have our offices located here in Australia, Singapore, and then also in Malaysia. Thanks very much for joining us today. I hope you got some benefit out of that, and it'll help you with your international dealing schedule and getting ready for those 30th of June year ends, or maybe many of you are scrambling with the 31 December year ends that need to be lodged within the next few weeks. And we'll hopefully see most of you all next week.
Thank you.
Thank you.